Hello, and welcome to another episode of the Common Sense Show. And I'm Micah, and I'm excited today because I get to speak to someone I've actually been looking forward to speaking to for a while. And he has revolutionized, in my opinion, the accounting industry, but not just how he does and delivers the accounting, but also just how he sees it work against how it used to work. And so one of the things that I'm always into is building businesses that are both effective and have good ideas about how they work and how they run, and that are innovative, because if you create faster than someone else can copy you, then you have a good formula for success. So I'd like to introduce you to Jody Gruden. But before I do, let me give you a swoosh and then I'll bring him in. All right. So Jody co-founded SummitCPA Group in 2002, which merged with Anders CPA and Advisors in 2022. Summit, now a division of Anders, was the first fully distributed accounting firm as the leading provider of virtual CFO services in North America. Summit provides professional virtual CFO services for over 100 companies across the United States, helping business owners dive deep into financial side of their business to maximize profits, minimize taxes, and increase cash flow. He's speaking my language. Jody's an industry speaker and a published author, and he literally wrote the book on helping digital companies create a financial roadmap to success. Digital dollars and cents, easy for me to say. Jody, welcome to the show.
Yeah, thanks, Micah, for having me.
Awesome. So I have a ton of questions because I'm curious, but I like your approach. First of all, virtual CFO services. For a small business owner, are virtual CFO services out of the realm of attainability? At what point should a business be thinking about a virtual CFO?
Yeah, so that's a great question. I get that quite often, actually. So there's many different levels of services, right? So you've got your back-end accounting services, which are more transactional in nature, like you got someone paying your bills or doing invoicing or payroll processing or something like that. And then you've got somebody that is responsible for actually making sure your financial statements are accurate so that you can present them to a bank, an investor, that type of thing. Yep. And so those are what we call the accounting 101 or historical stuff. That's what accountants have always done and have done really well over the years. And I would say a business should have somebody like that from, really maybe $300,000 or $400,000 up to about $1 million in revenue. So that's why I would say that's where they should actually kind of focus their time and energy on that right there, just making sure everything is cleaned up. And the reason why the business owner's heavily involved at that point, and they need to be a big part of that, just so they understand how their business actually runs. Once they get to that $1 million mark, I think that's when they really should start looking and having somebody on their team that can kind of help them get to that next level. And that's where we start seeing that the folks will come on with the virtual CFO service level. And I would say on average, I'd say $1 million what we see on the low end, and then it grows to about $3 million to $5 million. It's a definite at that point. Where they need somebody that kind of really guide them, through it, creating a dynamic forecast, really help them do some modeling, so that, and I don't mean the fashion modeling, I mean, financial modeling, right? And so they're kind of helping you, hey, how does the price increase impact my cash position in 6 months? If I give raises to my team, what does that mean? All the different things that people are typically just kind of guessing. That's where the CFO really, really helps out. And unfortunately, even at $1 million or $5 million, most firms can't afford to spend, $250,000 plus for a CFO to be on staff. And that's where a virtual CFO concept really, really kind of helps that out. So it allows the small business owner to enjoy what all companies, large companies across the world have, a CFO team on staff.
So I talk a lot about to small business owners, of course, around the world in general.
Yep.
And it's basically the focus that in entrepreneurship of this channel, this podcast. And I talk a lot about maximizing profits, trying to minimize taxes, increase cash flow, financial upside, all the stuff that you guys you pitch at Summit. And what are some of the most glaring after you've onboarded a new customer? What are some of the most glaring mistakes that are affecting cash flow with businesses that you see?
I would say the biggest mistake is a lot of times they take the wrong approach. They think that they've got to drain their cash at the end of every year to not have to pay as much taxes, and that is by far the wrong thing to do. Yeah, you want to minimize your taxes, but you don't want to do it at the detriment of your company. And so we tell everybody that you should have at least 10% of your annualized revenue in the bank at all times. So real easy math, right? So if you're a $300,000 company, 30 grand in the bank. If you're a $3 million company, $300,000 in the bank. So it's real quick math. And there's actually there's a real long formula that goes to prove that out. But that's just something that everybody can kind of mentally do. And that's the lowest amount. Now, I don't mean to have that in an operating account, not making any money, just kind of sitting around. You should always have about 2 paychecks in the bank in your operating account, or maybe 2 cycles of a credit card if that's your biggest expense. And then the rest of it should be in an interest-bearing account, whether that's a interest-bearing savings account earning, 1, 2, 3% interest, or something that's very liquid. And then the third account you should always have is your tax account, because again, taxes are something that you're going to pay if you're as profitable as you are. So you should have a really good idea what your tax situation is throughout the entire year, setting money aside into that account and then paying that out. Throughout the year, your estimated payments, and then you should have that dollar amount in there. So it's always kind of out of sight, out of mind. So you're never surprised, or you don't use that money elsewhere. So I would say the fact that most businesses do not have an operating account, they don't have a cash reserve account earning interest, and then they don't have another account which is kind of set aside for taxes, are the 3 big ones. But the overall big one is they typically don't have cash in the bank. And with our clients average about 15% in the bank, which if you do the math, 10% is 2 months of expenses for a service-based company, 30% is 6 months. So you want somewhere between that 10% to 20 or 30%, which is like 2 to 6 months of expenses.
What is the mindset typically that you've uncovered as to the reason why these business owners utilize essentially all the cash flow? Is it just a lack of organization?
No, it's a lack of focus. They don't know what that end goal is. And so, like when we tell people that, hey, you should have that 10% in the bank, for those that have maybe 3 or 4% or barely getting by, they're like, yeah, I kind of wish I had that kind of money in the bank. Duh, that's why I'm here. That type of thing. And it's like, well, it's because you didn't put a dynamic forecast in place. You didn't create the forecast based on real numbers, based on things that you can achieve. Like if you're a repair shop, let's say you're a truck repair shop, semi-truck repair shop type of thing. Well, you should know exactly how many trucks you need to come in every single month. You should know the average that you're going to repair for those trucks and the time that it takes to get that done. So you should be able to create a forecast based on the trucks coming in, which then equates to a revenue number, right? And then you should be able to back into the expense and then back into your overall. So you should know exactly where you're planning. And so when I come to an owner and say, hey, let's build that 10%, and let's get it done within a year and a half, and here's how we're going to do it, the owner can see exactly the path now. They can see the goal, and they go right to it. It's no different than, when I say forecasting, it's no different than like the GPS on a car, right? You're in Indiana and you want to go to Florida. Well, you could go south and you're eventually going to hit Florida at some point, right? You're going to hit the ocean and you're going to figure it out. That's kind of what the typical business owner does. They know how to get there. They'll eventually figure it out. Yeah. But, if you have a GPS there that kind of guides you in, shows you where the road construction is at, moves you around the road constructions, shows you what, all the different things that are going on in the bumps in the roads that are going to happen on that way to Florida, you get there a lot quicker, and you tend to get there, right? And that's kind of the key, is they don't have that forecast. It's kind of helping them guide the ship.
It's let's talk about forecasting for a minute, because what I've noticed is with the business, there are hundreds of thousands of businesses in the U.S., maybe a couple million, right, of small businesses. Yep. And oftentimes a lot of the terminology that's used in economics and in MBA in graduate school are things that business owners are doing. They just don't connect the terminology with the action. But they're already kind of doing it in some way, shape, or form. What are some of the resources, for instance, that you've seen that have worked out, that are simple, that business owners and entrepreneurs can use to understand the terminology with the action that they're putting in place? Investopedia is one website that is a pretty like lethal tool in terms of getting up to speed with terminology, all the way up to MBA graduate level concepts with explanatory videos. But is there something that you've used to educate business owners?
Yeah, another great question. You mentioned Investopedia. That's actually our go-to when it comes to, hey, here, before starting an engagement, if you want to get caught up on terms, here it is. But in the same sense, we as CFOs don't use terms, so we're not going to wow you with all the cool knowledge and terminology, vernacular that we've learned in MBA school and all that kind of stuff. We try to make it so that everybody understands, because it doesn't do us any good to wow you. We want to make sure that we're on your team and we're actually talking the talk that you understand. So like for instance, we could be talking about, hey, your churn rate in regard to the number of trucks that you're bringing through is low. It's like, well, hey, why not just say, hey, the amount of trucks is a lot lower than what you thought it was.
Right. Yeah.
Here's how. So if we can break it down so that we're talking the same language, and that's one of the big things that I learned when starting Summit was to, make it so that we're on the same plane. I never want to be talking down to somebody. And so the vernacular is not as important to us as the understanding. And because we're meeting with clients on a weekly basis, they start to understand pretty quickly, so they don't need to, they kind of go through an MBA program really in that first year with us, because they're meeting with us and going through stuff all the time, but we're really kind of helping them, walk the walk.
Awesome. And if you're watching this, obviously, if you're watching this on replay or on demand, or listening to this on the podcast, you can't do this. But if you're watching this live and you have questions for Jody, just put them in the comment section of the YouTube or Facebook, wherever you're watching this on, and we'll see if we can have him answer it. But so getting back to this, so forecasting is a crucial element to long-term financial success and viability for businesses, primarily because it tells you how much money are likely to have. Ceteris paribus, right? If all other things are held, all other factors are held constant, and nothing changes, like how much money will I have at the end of the rainbow, right? If everything goes according to my plans. So how can a business owner actually start forecasting on a simplified level, like now? Like, what kind of tips can you give for forecasting, like the forecasting for dummy version?
Yeah, no, that sounds great. So forecasting for dummies, and we kind of tell all of our CFOs, basically is how we tell our CFOs, here's how you teach somebody how to do forecasting. The first thing is you have to identify the metrics that actually make the world go around, meaning what drives the revenue in your business, what drives net income. And so is it, like I mentioned before, trucks. Is it trucks coming through? Well, how many trucks do you think you're going to have come through? And so I would take an Excel spreadsheet, dial it 12 months out there, and put down, hey, how many trucks have I historically had come through January through December, 5 in this month, 10 in this month, and then kind of look back and say, is that a normal thing or not a normal thing? And then I would take and say, how much did I get from each of those trucks? So I just had 5, let's say it's $80,000 a truck, just throwing a number out there. And so then now I've got a revenue number. And so that's going to be the key thing there, that revenue number. And then I'm looking for all the direct costs associated with it. What's my materials typically run for a typical truck? Is it 50%? Is it 75%? Is it 20%? What is that? And then I look at my direct labor. What type of direct labor has my existing team, did they manage that last year, or do I need to add folks? And so then I'm getting into all those direct costs. And so the first thing is predicting that revenue, because that's the biggest part of the forecast. And then any direct costs associated with that revenue. Once I've got that dialed in, then on a month-to-month basis, I'm going to look and see what are my administrative costs, what are my marketing costs, and what are my facility costs. Those are the 3 buckets that we tell people to jumble everything into outside of your main costs. And so, that administrative cost might be an office manager that you might have. It might be, somebody that's not involved in the production process. Maybe it's the owner. The marketing costs are going to be your biz dev team, your marketing team, any kind of advertising you're using. It's going to be their all-in cost. So if you've got an employee in there, make sure that you've got the cost of the employee, any kind of burden, which are the benefits that they might have, 401k, all that kind of stuff. And then any costs associated with the marketing. And then facility is pretty simple. If you're brick and mortar, then you've got like rent or, real estate tax, insurance, repairs, all the upkeep you have for your facility. And so you break all those out there. And so then now you've got them all broken out. and you've got it extrapolated over a period of time, you've got it all matched up, you should be able to get a pretty good idea on the cash side. Now, it's not going to be perfect on the cash side. Your net income is not going to equal cash all the time, but it's going to be relatively close. And the factors that could influence that would be how quickly you get your collections of your payments and all that kind of stuff. How quickly you invoice clients. Do you get paid right away? That's a really big factor in cash. And then the other thing is what kind of debts are you going to you're paying down? So cash isn't going to really be 100% on that number, but that'll give you a good number to base things on. And when you look at that bottom line number, that number should be, for a service-based company, should be no less than 10%. It should be closer to 15 to 25%. So when you do your modeling, kind of look down there and say, hey, is that number big enough? And it's kind of funny because we talk about service-based companies and all the different industries out there. Some industries think, well, hey, I can't be less. My industry is at 5%. There's no way I'm going to make 10%. Well, there is a way. You just kind of figure it out.
Right.
What do you have to do to get it to that number? And so once you've got that 10% and above number, let's say it's 15%, now you've got something to really kind of base things on. Now, the key to a forecast is once you've created it, and let's say you build it out in Excel and you created it and you're thinking this is pretty cool, don't just leave it there. Don't look at it next year. Don't look at it 6 months from now and say, oh, yeah. Right. I was way off in that forecast. How could I have made that mistake?
Yeah, that sucked. How did I get? I was here. How did I get?
Yeah, exactly.
That's awful.
It's awful.
Who did this?
That's exactly right. So you got to look at it every single month. Look at it every single month and make changes to it. Because a forecast isn't static. It's not something you compare from one to the next. It's dynamic. It's always changing, right? And so that, hey, based on what we've got, I had 5 trucks planned in March. Guess what? I've got my inventory backup is so big. I've got 10 trucks. I'm going to get 10 through there. Make that change. So now we've got 10. And so now we know what our new cash position is going to look like. Or maybe it went the other way. Maybe you had 2. And now we're like, oh my gosh, the cash position is going to look really bad at that at the end of stay there. So you've got to kind of really look at that, model it, and so you can make really solid business decisions. Because it's really easy to make a change in March that's going to affect November than it is to make a change in November that's going to affect November.
If you're a small business, so one of the things I actually started doing this year, which I didn't do before, and I'm going to be honest about this, I didn't do it before, but I did start doing it this year, was I put a projected column on my P&L. So before it was just live numbers on the P&L, which is fine. It's perfectly acceptable. Nobody would argue. Most people would just be impressed that I had one. And
Yeah, I would too.
but I included a whole column just for projected because you can use your P&L, your profit and loss, how much money you're coming in, less cost of goods sold if you're a manufacturer or whatever, and my fixed costs, and I can then measure one against the other as the month goes through, without having a bunch of additional Excel sheets that are forecasting sheets. You can forecast right to your P&L.
Yep.
I'm sure if you're a CFO, it's probably something that you would use more closely. But yeah, so since I started doing that, it is actually really nice because it helps you to re-establish your forecast, and you can go back to your master sheet with those actuals, because those are live goal numbers, but they're not actual numbers, right? So they're better for your forecasting in the sense that they make adjustments to the other subsequent months of your financials, but they're just as important to have as your as in my opinion as your actual numbers. What do you think about that?
Oh, 100% agree, because that's what we do every month, right? So we take all the actual numbers there, life hits us in the face, right? Unexpected happens. Then we mush that against what we actually have in our forecasted numbers. So we're always comparing it against our forecast, month by month, and then through the rest of the year. So as we're comparing it month by month, we're looking at it and saying, you know what, hey, Micah, why is revenue only, why do we only have 8 trucks coming through this month versus 5? Is that going to be a reoccurring thing, or is that just a one-off thing? And so, as you're thinking through your head, you're looking at it and say, yeah, that's actually a one-off thing, or so not a big deal. We're not going to make any changes in our forecast, right? Or you might say it's a real thing, and it's like, well, then we need to make some modifications.